Pleasure to be here and welcome everyone. I'm excited to share with you something that I actually haven't shared very much in the past. So this is a fairly unique presentation for me, and it's how to find and trade big market moves before they're seen by others. And of course, that is one of the hallmarks of professional trading, is getting in early. So we're going to jump right into it, and here we go. So I have a little bio. I'm not going to give you too much information about myself, but basically just to let you know that I'm a real trader and vetted by a lot of reputable companies out there. You can see I'm the author of Trend Trading for Dummies. I've received Reader's Choice Awards from Stocks and Commodities magazine. I've contributed to other authors' books and worked with major companies, continue to work with major companies, educating their traders, and there's just a few of the names. Of course, we've got to make the most important people in our lives happy, which obviously goes without saying is our lovely lawyers. So, but I joke about that, but really, this is no joking matter when it comes to these regulatory statements, because if you think of it, the regulatory statements came out of people's pain, and I don't want you guys to have pain. I want you to have profits. So I'm not going to go through and read all these, details here. I'm sure you've heard a lot of them before, but I do want you to see them and read them on your own. So this stuff is really, really important. It really is. I find that too many traders come in overly optimistic and thinking it's going to be easier than it is, that it's get rich quick, that they don't need any money to trade, blah, blah, blah. Okay, you got to get that out of your head, and you got to come into this as a professional and with your eyes wide open. And these statements are absolutely critical for your success. In other words, this is not just cover my butt legal stuff. This is for your success. It's really important that you have this type of mental attitude and know these things before you begin trading. Okay, so our topic for today, as I said, is how to get into markets before they make a big move, because quite often after they make a big move, the deal is done. And too many retail traders, amateur traders, beginning traders, they're looking for big moves in the market. And I mean, that's fantastic, of course. We all want that for a really good reward. But the problem is that they wait too long. And by the time it's seen by everybody, the deal is done. In fact, that's when professionals are getting out. So this is one cycle in the market. I'm really big into cycles. And so here's a couple of different cycles. I'll just list a few of them here just to give you a big picture of cycles or timing in the market. One of the most well-known are the calendar cycles. So you've got the Halloween cycle, for example. You get in at the end of October, early November, and in May you go away, right? So we're familiar with that. Retail cycles around Christmas time and agricultural cycles around the summer. So these are calendar cycles, very good to learn. Another one is just the up-down cycles. Markets make higher highs, higher lows, higher highs, higher lows. So those would be cycle highs and cycle lows. Those type of swing moves are very important. A third one, by the way, I just did a YouTube video on this. So if you want to learn more about this cycle, the order chaos cycle, go to YouTube, type in topdogtrading.com and go to my channel. And this is the latest video on this. This one's really important because if you've ever had the experience where you've made money and you start to feel like, oh my gosh, I'm actually doing great, and then you give all the money back over a series of trades, it's usually because no one's taught you the order chaos cycle. A lot of times, well, most of the time, frankly, the market is in a chaotic or random period, a cycle or period. I combined cycles and period there. And this is what the famous book, Random Walk Down Wall Street, basically talked about, although they at least initially felt that the markets were completely efficient and therefore you really could not get a probability scenario. I think that is true most of the time, but there are times when the market gets into a very orderly move. This is usually when you get accumulation through big professional firms and so forth, and we can establish a probability scenario, and then the market trades in an orderly fashion. And those are the only times we want to trade. Another type of cycle is the coupling and uncoupling cycles. So this is where certain industries, sectors, commodities, currencies, whatever will trade like each other very similarly. And then all of a sudden they uncouple and they start trading differently than each other. That's a really great opportunity for a trade when you catch that immediately. Now, the fifth type of cycle, the one we're going to focus on right now, is volatility cycles. Volatility cycles refer to the fact that markets will often cover a wide range, have big swings, and then they'll do that for a period of time, and then they get back into more of a contraction cycle, so low volatility. The markets tend to cycle between high volatility and low volatility times. So talking about that, these are the questions that come up. Okay, so knowing that we have these types of cycles of high volatility to low volatility back to high volatility, what patterns do we trade? Number two, how early or late do we get into these various cycles of volatility? And number three, this is a big one I get asked all the time, which direction do I trade these breakouts of low volatility? Number four, when exactly to enter? And number five, when exactly to get out? Good questions, so let's answer them. So here are some patterns to trade. And many of you will be familiar with these. Bollinger Band squeezes. So that's a low volatility period in the market. You are in a contraction cycle when you have a Bollinger Band squeeze. Contracting channels. So the market's directionless, but it's a narrow range going sideways. Number three, wedges. These usually occur at tops and bottoms. They're similar to triangles, except both the top and the bottom angle are sloping up or both sloping down, but they're contracting. And again, this will usually happen at the end of a big move. Really, really great to either get out of a trend or even for trend reversals. Triangles, I'm going to show you how I trade triangles today. And moving average convergences. And that's when you don't hear too much about. So this last one is probably the one that you're least familiar with, or at least most of you have not heard of. So I'm going to tackle these last two for you today. We're going to focus on the moving average convergences and triangles. All right, so let's deal with the one that is not as commonly taught. Moving average convergences. Let's show you how to trade these little puppies here. So here are the moving averages that I use. They're listed up here, you can see. 15 EMA, the 50 SMA, the 100 SMA, and the 200 SMA. Nothing magical about these particular moving averages. If you have others that are your favorites, that's fine. But I like the fact of having a very rather short-term one and then a really long-term one. And the reason is because, and here are, if you look inside this little box here, you can see that all four moving averages are all pretty much right kind of binding together. I've heard one trader call this a binding pattern, or a cord. Yeah, like a cord, like the ropes you tie together and kind of twist together. So those are all pretty good images. I like those. So we've got now mathematically, let's talk about this just from a very concrete point of view. What is really happening? Moving averages are mathematical formulas, right? So literally when you see this pattern, or all four moving averages are very, very close together like this, I mean, it literally means that the market has not made any significant move within the last 15 bars, 50 bars, 100 bars, and 200 bars. So that's what it's literally mathematically telling you. All right. Now I've got this on a 3-minute chart. Doesn't matter. You could use this. By the way, you can use it with stocks, commodities, options, E-minis, Forex, whatever. You can do this with daily charts, weekly charts, tick charts. It's the mathematics of it that's important, that you are now finding a contraction pattern. In other words, this is one way of the how to know when you're in a contraction cycle. All right. So now that we see the setup, here's what we're looking for. So there we go, just expanding, looking out into the future. I'm showing a day trading example here, but again, could do this with swing trading as well. So the bars, notice that the bars are right, just basically touching the moving averages, and they're all kind of converging together. So knowing that the market has these cycles of contraction and expansion, we're looking to find the contraction and then trade the expansion. So now here's what happens. It breaks above the moving averages and still kind of goes sideways, hits a resistance level. That's just a previous major swing high. Comes up here, comes back down into moving averages. But look what happened now. The moving averages have turned into what we call a stacking pattern. So the black line is the 15 EMA, the blue line is the 50, the gold line is the 100, and the purple line is the 200. So this is what's called a moving average stacking pattern, where the shortest term is on top and the longest term is on bottom. And that's why I like to use a real short term and then a real long term. And again, it helps, really helps all the way, whether they're binding together or they have separated. And so now, where do you get in? You have several options. It just depends how aggressive or conservative you want to be. So some people, you could look at this and you could get in right here. Now, if you did, that's a very, very, well, a very aggressive trade, right? And I would say your win-loss ratio will be lower, but you'll get in earlier. I mean, sometimes these things will just shoot right out of there. Other times, they'll kind of pop out of the range, get outside the top of, look for a high of a bar here that's formed during that period of time and break out above there. But this time it just kind of meanders forward, goes up to the next resistance, typical, comes down, and then boom, that's when it explodes. And I found sometimes that these are good patterns too. Wait for it to break out a little bit and then wait for it to come back in. It will often do that. But the difference is, yes, it's come back into the moving average stack, but again, the moving averages have separated. You've got that stacking pattern, whereas here you don't. Another option is you can combine both styles, both aggressive and conservative. You could say, okay, I'll take some position here because heck, who knows the future, right? We don't know the future, what's going to happen. Nobody knows the future for sure. And so we use basically money management principles, risk management principles. Some people, you might say, okay, I'll take a half a position here or a third, a quarter, whatever you want to do. Hold a bit. Okay, maybe take some profits into this little resistance here just in case that's all it goes. And then when we get this, okay, boom, I've already got some money here. Now you can, move your stop below the low of this range or whatever. And see, we're really looking when we take these trades, our ultimate goal is not these little moves. Our ultimate goal is to see real expansion, big, big, big moves. They don't always happen, and that's why we use money management and risk management in these kind of patterns. So I personally, this is what I would do. I would take some profits right here, lock into profits. You could maybe move your, stop up a little bit if you want to, but even if you don't, even if you do get stopped out, you're getting stopped out on half your position. Let's say if you took half your profits here. So basically you still have either a scratch trade or you made a little bit of money. But see, the cool thing is your risk on these is really puny and the reward is really great. And then we look for our next resistance zones. Okay, so that is one example, and that's one I don't see traded too often. So let's go to triangles for our second example, and gosh, we're making pretty good time. I might even show you I might give you a bonus trade here today if I have time. So I've only got 15 minutes, but we'll see how it goes. All right, so now this one is the triangle. So we're all familiar with triangles, but I'm going to show you a few nuances, a few details that you may not have heard before, because I've got this ancient Chinese saying. And that ancient Chinese saying that I just made up is that the dollars are in the details. So we all know triangles probably, but I'm going to give you some details here that can make you some extra money. So this is a symmetrical triangle. So we have a lower high and higher lows. Alrighty. And that by definition means that we are now contracting. See, before we had higher high, higher low, higher high, higher low, whoops, lower high. Okay, so we got a contraction pattern happening. And what we're looking for, what is now to start a high volatility move, contraction into expansion. But most people trade triangles two different ways. Some people will trade the breakout. So they'll wait for the market to break this trend line down here. Okay, that's one valid way to trade a triangle. Other people will wait for a throwback. That means you wait for the breakout and then a retrace. That is also a valid way to trade a triangle. Those are both fine. They both have their advantages and disadvantages. If you trade the breakout, the advantage is if it just goes from there and goes crazy, well, you're in. But the disadvantage is if it does retrace, then you've got to hold that and the money is moving against you, your P&L is turning red, and psychologically you've got to hold through that. So the advantage of waiting for the throwback, by the way, this is actually called a throwback, not a retrace technically in technical analysis. The good news is then, okay, your risk is smaller. You don't have as much risk on the trade. Usually the win-loss ratio is better on the throwback setups. The disadvantage is you may not get it, right? Because maybe it won't retrace back up here. Maybe it'll just break out and keep going down. And then you're like, dang, didn't make any money. Okay, so most things in trading are like that. Advantages, disadvantages. Again, if you want to, you could enter with a little bit here, wait, and then if you get the throwback, add and put on your full position here. So that would be another choice for you. A lot of trading comes down to what you are comfortable with, what your risk tolerance is. Now, I don't do either one of those, frankly. I mean, sometimes I will, but that's not my normal way of trading. I'll do it if I see it after the fact, and it's like, oh, it's really sweet. I never trade the breakout, personally. That's just not my style. My style, my preference is to trade here. I call that trading inside the triangle. And I do this with all types of contraction patterns. I do it with the moving average convergence. I do it with Bollinger Band squeezes. I do it with everything. But I love, love, love triangles. Back when I was the head moderator of a chat room, I used to be called the Triangle Master because I'd be trading triangles all day long. And for some reason, I could always see them. And I don't know, they just resonated with me. But I trade inside the triangle. So I go short here. And the advantage of that is, number one, by the time everyone else is getting in, they're just adding to my profits. So I'm in before them. Again, hallmark of trading is get in earlier than everyone else. We're not waiting for as much confirmation. Psychologically, there is a downside to that. A lot of people feel that they need the extra confirmation to have more confidence to trade. Problem is, again, by the time you get all that confirmation, everybody in his parakeet sees it, and it's less likely to continue. So we trade as professionals with less confirmation, but we stack the deck in our favor with other things most people are not aware of. Like most people aren't even aware you can trade this. So I'm entering here. My risk is tiny. I would actually put my stop above here, not above here. No, I'd put my stop right above that swing high. So my risk is minuscule, and my reward, if this thing breaks out, is good. So tremendous reward to risk ratio. And when it breaks out, if I get throwback, I might even add more to my position there. But see, I'm getting a worse price here. Now I'm getting in down here, whereas here I'm getting in up here. So you're getting a better entry because you're getting in earlier. You're shorting a higher price. Your risk is smaller, and therefore your reward is bigger. And that's what I call trading inside the triangle. Very, very powerful. See if it works for you. I mean, it works. I can tell you it works, but I can also tell you, being in the chat rooms and so forth, that I find a lot of people have a hard time seeing this for whatever reason. So see what works with your brain cells, what resonates with your brain cells. Now, here's a couple of other dollars that are in the details. So this is not only a triangle. See, this is how, when I said, okay, I can trade inside the triangle because I don't have a lot of confirmation. In other words, we don't have the breakout, we don't have the throwback, but I've got other stuff that stacks the probabilities in my favor. What are those other things? In this particular case, what I have is a wave 5, which is an average trend, by the way, statistically. And I've got a head and shoulders pattern. Higher, high, lower, high. So we're late in a trend, meaning that, as we all know, the trend is your friend until the end. So if it's coming toward the end, that's when I might want to trade a trend reversal anyway. So I actually have 2 trades in one. I have a trend reversal trade and I have a triangle trade. I've got a head and shoulders pattern late in a trend, By the way, head and shoulders pattern early in a trend, wouldn't trade it. I don't care that the pattern is there. Timing within how late in that trend is critical. I only trade head and shoulder patterns late in a trend. So that puts the odds in my favor. The fact that we've got a head and shoulders pattern puts the odds in my favor. And the fact that not only that, but we're also now in a contraction pattern at an extended trend when the trend is my enemy puts the odds in my favor. And putting all that together gives me more confidence then to trade inside the triangle before we break out. All right. So to me, these are the best kind of head and shoulder patterns, the ones that have a triangle. Okay, so we got about 6-7 minutes left, so cool. I have time to give you one more bonus setup. In this one, I call it detachment from equilibrium. This is, again, another type of contraction pattern. So here is the equilibrium I'm talking about. Now, this one's primarily for day trading, but you can use this for Forex, stocks, futures, E-minis, whatever. But it is a day trading setup, whereas the other two can be any time frame. So what we do is we put our floor trader pivots on the chart. The PP here stands for pivot point. Some trading platforms will call that central pivot. That's fine, different names for the same thing. So central pivot or pivot point, whatever, that's your equilibrium point. Another equilibrium point in the market is the previous day's close. Wherever the market closed yesterday, professional traders are always looking, are we above that or below that? What's the relationship of price today compared to where we closed yesterday? So if we're above it, it's a bullish day so far. If we're below it, it's a bearish day relative to yesterday. So I take both of those and I have them on my chart and I look how close they are together. That zone between those two, that's the equilibrium zone. So as long as we're in there, I consider it a neutral market. So on this particular day, this is the beginning of the day, we gapped up. You can see at the end of the previous day, we gapped up, we closed the gap. Then we went, that's yesterday's low. Boom, 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 boom. Right now, here's the thing. We come back into the equilibrium zone. And when we do, that's another type of contraction trade. It's really more, to be more literal about it, I would say it's more of a reversion to the mean type trade. So the market is always trying to decide whether it's bullish or bearish compared to yesterday. And so when it's in the neutral zone, it's, well, neutral. So we're looking for it to then, for the market, when I say it, I'm talking about the masses of the market participants, to decide, okay, which way are we going to go? So these are, sometimes they're short-term trades, sometimes they're long-term trades. I've seen these once in a while go all day long, but that's the exception to the rule. That might happen once or twice a week. So we wait for it to come back in here, and then we trade it out of that equilibrium zone. All right, here's another little example, just highlighting a little better for you to see the this little zone here, equilibrium zone. Same chart, by the way, breaks out, comes back up. Okay, and notice this is yesterday's low. So a lot of people will trade above yesterday's high or below yesterday's low. Those are bullish and bearish indications. That is true, but I find that those levels are gamed a lot because everybody, again, knows them, everybody's watching them. And I just find, again, it's too late. So for me, trading the breakout of yesterday's low, I don't do it. I've got too much experience. I've seen this happen too often where it breaks, comes back up. So I want to get in before it breaks down through yesterday's low, get into this equilibrium, and then really my ultimate goal is to see it go through yesterday's low and keep going. But I'm not going to wait for it to break yesterday's low. So again, I'm getting in early. But the ultimate idea is hopefully to, yes, break below there. But if it doesn't and it comes back up, I can still make some money. Because why? I can still say, okay, well, wait for a cycle low here and take some profits, right? Lock in some profits, move my stop to break even. And at that point, I'm golden. I'm just playing with the market's money. And that's the big deal with getting in earlier on these trades. You can really manage your positions by taking some profits, moving your stop to break even, and then boom. I mean, it's just, if you could do that in every single trade, you're going to be pretty good, right? Even if they don't work out. And then the ones that do, well, you just make more money. So you either make money or you make more money. That's how I like to play. Okay. So, but yes, you've got to have some, good reasons to get in early. And I demonstrated that the best with the triangle trade. That's not just the triangle, it's the other things as well. So you can add candlesticks, you can add your multiple time frames, you can add price patterns, but it's really the compounding of the preponderance of evidence. It's almost like putting together a legal case where you want a lot of evidence that is not correlated to each other. It's like if you get 5 people going up to the witness stand to testify against someone, well, you want to have those people as independent as possible. If it's the accused brother and mommy and girlfriend and best friend, testimonies aren't going to be as compelling. But on the other hand, if those 5 witnesses don't know each other and don't know the defendant, and they all give the same testimony, pretty darn reliable. And that's the same in trading. It's really all about putting together a preponderance of non-correlated variables. So here's another example, and you can see, so same thing, boom, boom, boom. But see, this is one where it just went bam, and that's what we're looking for. This is when it finally committed below yesterday's low and went all the way down to the mid pivot between S2 and S3. And that is our ultimate goal on these type of trades. By the way, look how well the pivot points work to support resistance there. So important factors are these, which patterns to trade. I gave you 3. Which direction? I always trade in the direction of momentum of the higher time frame. That's how I determine which way I think it's going to break out. And then how early or late to enter. I have a timing indicator, which, by the way, I'll be happy to give you for free. And that really pinpoints my entries and my exits with pinpoint accuracy. So here's what I have for you today. I actually didn't bring anything to sell. I kind of dropped the ball on that one, but I do have some free stuff for you. So here's what I've got for you for free. It's and I'm going to type this into the chat box here, the link. So as you can see, it is a 5-day free video course. And on this video course, we teach you professional trading and a lot of these distinctions I talked about today. So 5 videos. At the end of each video is an interactive quiz. You can test yourself to make sure you got the information correctly. I'm actually going to not only give you theory in this course, I'm going to give you an actual trade setup that you can start trading and hopefully start making some money before you have to invest anything in me. But again, trade this obviously on a paper trade it or use a simulator or demo account. But I teach you everything in the trade about when to get in, when to get out, all the confirmation and all that stuff. And then, as I said, my cycle indicator, I'll be happy to share that with you for free. We modify an indicator that's already on your chart, so it really works with any charting platform. And I provide that on another webinar. So we get the indicator set up on your charts at the first half of the webinar. And then the second half of the webinar, I show you the techniques of how to trade it, how to identify the actual triggers on it. And so here is the link. And as you can see, we used a bit.ly link, traders-fest.